Introduction to CAPM by Mobeen Ajmal. Welcome to this introductory session on the Capital Asset Pricing Model, or CAPM for short. In this video, we'll discuss the relationship between risk and return, how CAPM is used to price risky securities and assets, and its relation to the capital market line, CML, and security market line, SML. CAPM is a finance model that establishes a linear relationship between required return on an investment and risk. It is based on the relationship between an asset's beta, the risk-free rate, and the market risk premium. Investors expect to be compensated for risk and the time value of money. The risk-free rate in the CAPM formula accounts for the time value of money, while the other components of the formula account for the investor taking on additional risk. The beta of a potential investment is a measure of how much risk the investment will add to a portfolio. The beta of the market is assumed to be 1, and the beta of government securities, the risk-free securities, is assumed to be 0. If a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta of less than 1, the formula assumes it will reduce the risk of a portfolio. The goal of the CAPM is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared with its expected return. By knowing the individual parts of the CAPM, it is possible to gauge whether the current price of a stock is consistent with its likely return. Now, let's talk about the capital market line, CML, and security market line, SML, and their relationship with CAPM. The capital market line, CML represents portfolios that optimally combine total risk and return. CML is a theoretical concept that represents all the portfolios that optimally combine the risk-free rate of return and the market portfolio return of risky assets. The portfolios with the best trade-off between expected returns and variance, risk, lie on this line. The tangency point between the efficient frontier and the capital market line is the optimal portfolio of risky assets, known as the market portfolio. Theoretically, a market portfolio is a hypothetical collection of investments that encompasses all available assets in the investment universe, with each asset being weighted based on its overall representation in the market. The expected return of a market portfolio is equal to the expected return of the overall market. The security market line, SML, on the other hand, is a graphical representation of the CAPM formula. The SML shows the relationship between the expected return and beta of an asset, given the risk-free rate and the market risk premium. The slope of the SML represents the market risk premium, which is the return expected from the market above the risk-free rate. In conclusion, CAPM is a useful tool for investors to evaluate the risk and return of an investment, and the CML and SML can help investors understand how to optimally allocate their portfolios. Understanding the interpretation of beta is also essential in determining an investment's risk profile.